Good morning. Let's get started. So, housing was a major cause of this crisis and recession. The other major factor was the financial crisis and its impact on credit markets. That is another reason that recovery has been somewhat slower than we would have hoped. As I have discussed, the US banking system is stronger than it was 3 years ago. The amount of capital in the banking system over the past 3 years has increased by something like $300 billion, a very significant increase. And generally speaking, we are seeing credit terms getting a bit easier. We are seeing expansions in bank lending in a lot of categories. So there is certainly some improvement in banking and credit. Nevertheless, there are still scenarios where credit remains tight. I have already talked about mortgages. If you have anything less than a perfect credit score, it is very difficult to get a mortgage these days. And other categories, such as small businesses, have also found it difficult to get credit. It is well known that small business is an important creator of jobs, so the inability to start a small business or to get credit to expand a small business is one of the reasons job creation has been relatively slow. Another aspect of financial and credit markets has to do with the European situation following the financial crisis in Europe, which was very severe alongside of ours. There is now a second stage in which the solvency issues of a number of countries, the concerns about whether countries such as Greece and Portugal and Ireland can pay their creditors, have led to stressed financial conditions in Europe, and those have negatively affected the United States by creating risk aversion and volatility in the financial markets. A lesson worth drawing from this is that monetary policy is a powerful tool, but it cannot solve all the problems that there are. And in particular, when what we are seeing in this recovery is a number of structural issues relating, for example, to the housing market, to the mortgage market, to banks, to credit extension, and of course to the European situation, where other kinds of policies, whether fiscal policies or housing policies or whatever they may be, are needed to get the economy going again. So the Fed can provide stimulus, it can provide low interest rates, but monetary policy by itself cannot solve important structural, fiscal, and other problems that affect the economy. This is all rather discouraging. Again, it has taken a while to get back to where we are, and we are still a long way from where we would like to be. So let me say a few words about the long run. We did have, of course, a major trauma. The crisis was very deep. We have a lot of people who have been unemployed for a long time. About 40% of more or more of all the unemployed had been unemployed for 6 months or more. And if you are unemployed for 6 months or a year or 2 years, your skills will start to atrophy and your ability to get reemployed will decline. So that clearly is a problem. And then there are many other issues that the United States was facing even before the crisis, such as federal budget deficits, and those have not gone away. In fact, they have gotten somewhat worse through the recession, so clearly there have been some real headwinds for our economy. That said, I think it is important to understand that our economy has faced many short term shocks in the past, and some not so short term, but it has always been able to recover. We have a lot of strength in this economy. It is, of course, the largest economy in the world. Between 20 and 25% of our output in the world is produced in the United States, even though we have something like 6% or less of the world population. And the reason that we are so productive has to do with the diverse set of industries we have, our entrepreneur culture, which still is clearly the best in the world, the flexibility of our labor markets and our capital markets, and our technology, which remains one of our very strongest points. Increasingly, technology has been driving economic growth, and with some of the finest universities and research centers in the world as magnets for talented people from around the world, the United States has been very successful in the research and development area. So that has also been a source of ongoing growth and innovation in our economy. Again, we have weaknesses, and the financial crisis highlighted a few, but we have also tried to address them by strengthening our financial regulatory system. I find Ben Bernanke found figure 39 interesting to put in perspective what I have been discussing during these lectures. The dashed line shows a constant growth rate of a little over 3% in real terms. This is a log scale, so the straight line means a constant growth rate. And you can see that going back to 900, the United States, 1900, the United States economy has grown reasonably consistently at around 3% annually for more than a century. In the 1930s, you can see the big swing as the Great Depression pulled actual output below the trend line. And then you can see the movement above the trend line during World War II. But look what happened after World War II. We went right back to the trend line. There were recessions and booms and busts in the post war period, but growth remained fairly close to the trend line. Now, if you look to the very far right, you see where we are today. We are below the trend line. There are debates about whether that decline is permanent, but looking at history, I think there is a reasonable chance that the US economy will return to a healthy annual growth rate somewhere in the 3% range. There are factors to take into account, such as changes in our population growth rate, the aging of our population, and so on. So it's not real GDP per capita. but but broadly speaking, what this graph shows is that over long periods, our economy has been successful in maintaining long-term economic growth. I will say a few words about regulatory changes, and I will read that part tomorrow.